So moved.
Second.
Paul, Jody, all those in favor of approval of the minutes from the April meeting, say aye.
Aye.
Any opposed? All right, number 3 on the agenda, the request for benefits. We have 11 civilian requests and 1 police request. We will cover the civilian request first. Anything we need to know,
Yes.
Becky?
Yes, sir. So on the agenda, it says that there are 11 civilians. We did have 1 civilian call us Tuesday and asked to return to work, that their application for retirement be withdrawn. So, in working with our amazing payroll team, we were able to allow them to return. Their supervisor was very excited. And of course, when somebody likes to stay, we like to keep them. So it is now 10 civilians and 1 police officer. Thankfully, you guys had not approved those board orders yet, so we were able to elect that person. Your materials you have in front of you, board members, do not include him.
Okay.
Thank you.
What was it, cost of housing or something? Trophy or anything?
I did not ask. I just said thanks for staying.
Probably thought we might get lonely. All righty, we have a motion to approve the 10 civilian requests. Motion, Jody, I'll second the motion.
Thank you.
All in favor? Aye. All right, we have 1 police request for retirement. I have a motion to approve.
Second.
Paul and Jody, all those in favor?
Aye.
We're moving right along here. Application for death benefits, unfortunately. Civilian requests, are there any, anything we ought to know there? Everything is, sometimes there actually are some degree of controversy on some death benefits just because of family issues. All right, may I have a motion to approve civilian requests for death benefits? Second. All those in favor, say aye.
Aye.
And I must have overlooked the police requests. I did know those. All right. Very good. Let's move on to the performance report from ACG.
Okay. Thank you. I'm going to go through the quarter report today, really touching on some more high level total fund metrics. How the fund is done on a dollar basis relative to your policy benchmarks and also relative to peers. And I want to drill down a little bit on peer groups because I think there's some, a lot of things are lost when we just look at the quarter end return versus the median peer and what that really means. So just starting out, I'm not going to talk a lot about the markets, but just for perspective, and as we talk about peer groups, it'll come into play. Just looking at the year to date, large cap continues to be the best performing asset class. Over the last year, and this is really, like we're going to use a different report than that, the quarter report. The last year through yesterday, the S&P is up 28%. Small cap is up 17%. International is up 13%. Emerging markets are up 14%. So all very strong double-digit returns, but on a relative basis, large cap is outperforming everything else by 10+%. Bonds over the last year are up 2%. On a year-to-date basis, bonds are down a bit as rates have come up. And that really holds through for the trailing 10 years. Large cap is outperformed quite a bit. As we look at your portfolio, your large cap portfolio has done well. Relative to the policy, the broad policy index that we'll look at, your broad policy index is just 2 components, the ACWI, which is a global stock benchmark, and the US Ag, which is a investment grade bond benchmark. The ACWI is more large cap dominated.
You're looking at page 11.
I'm not looking, I'm
I
just,
mean, you're speaking on page 11.
Yes, you could reference the page, would be helpful.
okay, I really wasn't referencing any
It's
page.
non-US equities, just so we can follow along.
I have a letter to non-US equity investment firms.
Okay, that's not, I wasn't really talking about any page. I was just talking.
Okay, fine, go ahead.
We'll look at. And then,
Page,
I'll
page
direct
9
you
might be helpful.
to
Go ahead.
pages in it.
Page 9, I think is,
No,
and 8 and 9.
the ACWI is not on that page, but nonetheless, from a portfolio construction standpoint, your portfolio is very diversified, much more levers than just large cap US equity. And relative to the broad policy, you're probably a little bit more in small cap, more exposure to small cap stocks, which has had some impact relative to that broad policy. And then certainly real estate, which is not included in the broad policy index. When we look at the strategic policy index, that's more reflective of your actual asset allocation. So why don't we just go to the portfolio on page 20. Always like to look at dollars. More often than not, we're talking about percentages and relative percentages, but you pay benefits in dollars. So over the last decade, if we went back 10 years ago, the portfolio market value was a little under 600 million, 590.5 million. That net additions of negative 222.2 million, that's with a mature pension system, we're going to have net cash outflow. You're paying benefits, you're paying other expenses, and then you also have contributions coming in, but that's the net cash flow. From a return on investment standpoint, the portfolio has grown by a little under 500 million over the last 10 years. So at the end of March, the portfolio stood at 864.8 million. You'll see the last 1 year period, ending March, it was a very strong double-digit return of over 12% return over the last 1 year. And that equated to almost $100 million growth in the portfolio. 3 year numbers, the return on investment, a little bit less than net additions. That 3 year number includes a very significant drawdown in 2022. So that's, you've got a good 2021, a good first part, a good 2023 for the most part, and a really big drawdown in 2022 as both stock and bond and markets were down. Page 21 just looks at your overall asset allocation. But before we look at peer group rankings, I'm just going to give you some perspective. We're using a public pension peer group that we compare you to. The slice of that peer group that we're focusing on is those funds that report between 100 million and $1 billion. So you're in that range, you've been in that range, you're on the upper end of that range. That said, the observations in that peer group really skew to much smaller funds, closer to 100 million than the billion. It's very skewed. The median allocation, and let's pick on a couple things that are impacting your relative peer group rankings right now. The median allocation to US equity in that peer group is 42%. Your allocation to US equity on a target basis is 31%, and on an actual basis, about 34%. So a lot less US equity. Within the US equity, generally, we're seeing a much higher skew to large cap, which has been the thing that's done the best. So you have less US equity by about 8% and less large cap than peers. So I know there's talk about what.
Excuse me, was that less as a percentage?
Less is invested, less is a percentage of the portfolio invested. So relative to peers, relative to that peer group that were the 100 million to $1 billion. Real estate, the median allocation to real estate in that peer group is 8%. You have 15%. So that's in the 94th percentile, meaning you have an allocation to real estate that's greater than 94% of the peers in the peer group. Real estate over the last year, the worst performing asset class. It's negative, everything else is positive. So that's really impacting near-term results relative to this peer group. If we go to the next page, you'll see, look at on the right side, the 1 year, and I touched on all these things, total portfolio, very strong return, up 12.18%. Go down a couple rows to the strategic policy index, that's representative of your actual asset allocation. So it's taking the weight of large cap, the weight of small cap, the weight of international, EM, and fixed income, and Odyssey for real estate. That represents your actual allocation. So your managers are actually outperforming your most relevant benchmark. Relative to that broad policy index, this last year has been challenging, and this gets back to, there's no real estate in that broad policy index, and there's a lot less small cap in that index. Relative to the median peer in this peer group, we're about 1.5% behind the median, ranking in the 70th percentile. And if you go down 3 years, the 3-year number trails a little bit more of those two marks and in the 80th percentile. 5 and 10 years outperforming your strategic policy index and above median relative to the peers. I'm going to hand out the same page that's looking at man, if you could pass it over there. Yep. So what I just handed out was that same page, but looking at a different peer group. This is a smaller, this is actually unique to the one that we're showing. This is larger plans. This is over $1 billion. And you'll see relative to plans over $1 billion, and you're right at 900 million, your peer group ranking changes dramatically in the 1 year, down, it's a little worse in the 3 year, and I'll touch on why. And then in the 5 and 10 year, a little bit better. The way you're allocated, it's never going to be perfect. It's never going to be perfect to match up with a peer group. It's different, but the way you're allocated looks more like larger funds than smaller funds. The median allocation to US equity in the over $1 billion is 23.5%. So about 20% lower than that 100 million to $1 billion. And that's because when you get over $1 billion, you're going to have plans that have significantly more private market investments, both private equity and real estate. The median allocation to private equity in the over $1 billion is 14%, or as I didn't mention that, and the under the 100 million to $1 billion, it's 7%. So that's having a big impact. The median allocation to real estate here is 8%. So it's still less than you have. But you can see what that does relative to the peers. In the 1 year, you go in one peer group, you're 70th, and in the over $1 billion, you'd be 29th. The 3 year number looks a little bit different because 2 of those years were 2 of the best years for private equity, 2020 and 2021. Particularly 2021 was a standout year for private equity and venture capital. While you have an allocation there, it's in its infancy. So, I'm just pointing this out to show that when we're looking at peer group data, there's a lot of things going on. The other piece that you should have is, I think it's a staple piece. It says rolling returns and ranks. And I always think this is.
Jason, before you get off that, does it raise the question whether or not we are using the right peer group when we do our quarterly analysis? So we're using them for the 100 to $1 billion. Should we be using a different group?
I think maybe look as we do this work, and we could use the over $1 billion, but we're not quite there.
Yeah.
We can take different cuts. I mean, they're never going to be perfect, Mel. And I think having an understanding of what the average allocations in those peer groups look like is helpful. So I felt like we needed to really explain that. We're really seeing that.
I agree with you. I just want to know, get your opinion as to whether or not we ought to continue using what we're using? Or should we skew the peer group to the larger? Because we're at 840 million.
I think we can continue to show both, and maybe we didn't show like a 500 to a billion because once we start cutting it up, there's fewer observations and it doesn't look that different. So we can.
We'll give some thought, give some thought. We don't do it now, but I would like a definitive answer for
Okay.
the next meeting.
So the other
And
piece,
the answer may be no change. I just want something to try.
You probably said it, I'm gonna miss, so what's the real estate, in the peer group, the real estate allocation?
over $1 billion.
No, that's below.
It's
I know it's 8%, but what was it?
it's about it's 8. It's about the same
Oh, it
for
is.
both 8%. Yeah.
To real estate,
Yes,
whereas we're at 15.
at 50. So that's a big impact in the short term. That and US equity, having less US equity compared to peers, you have a lot less large cap equity right now.
Is the fixed income comparable?
Fixed income is comparable. Mhm. It's about 24, the median is about 24 in both universes. Now, that's a very broad description. What, how that looks, what people are doing could be different, but for the most part, that's pretty comparable. So this other staple piece that we put together is looking at rolling returns. So what we just looked at is focused on ending this quarter right now. And so a lot of times we get caught up and saying, well, 1, 3, 5, 10, right now.
We have the staple. I don't think we have the
We
staple.
don't have this.
You don't have.
Is there a summary page in here that shows
Does anybody
the
else?
allocations to
I
different
don't think anybody's got
classes? The low and the high ends per the policy index of the,
Per year policy. On page 21.
no, not over under where we are right now. The exposure allowed, in terms of what you're following, what the minimum and the maximum.
Oh, the ranges?
Yes, the ranges.
I thought that was on that page. We don't have that in here. I can get that for you.
Yes, please.
Well, that's in the investment policy.
Yeah, it's in the investment.
Correct. So I would like,
Yeah.
just point me if I have one somewhere.
Okay,
I don't see
Yeah.
it, so
we can add that to this page too.
yes, please. Because, I'm assuming the real estate was within that range, of course, so
Yeah,
the allocation.
The real estate is within the range, certainly.
Yeah.
And we've had redemptions into real estate to bring it down. But you're in private real estate, so there are exit queues in private real estate where it takes time to get out. So when it gets overweight, you can't bring it down to target weight immediately, or even underweight. It's much harder to move. So the piece I just handed out is looking at rolling returns. There's 3 pages. One is 3-year, one is 5-year, and one is 10-year. So what this is doing, and I'll start on this one that says rolling 3-year. This is looking at every quarter going back 3 years. Just to point out where we are today and really where the deviation relative to the peer group began in mid 2023 or between June and September of 2023, you start seeing that 3-year peer group ranking coming down. And this is really when real estate started to go down dramatically. That far right column that says average 3-year.
This is not what I have here. I'm missing something. Oh, that's right here. Okay, fine. All right, sorry. Okay. Good.
That average 3-year, what that is, that 8.11, that's your portfolio. That is the average of the trailing 3-year return every quarter. It's not an average annualized return. It's looking at the last 21 quarters and saying, on average, we look back 3 years, your portfolio has been at 8.11%, whereas the policy index 7.5. And from a peer group ranking standpoint, you've averaged in the 36th percentile, the top third on a trailing 3-year basis. We look at 5 years, similar. So this is just taking us a little bit further back, but it's every quarter, looking back 5 years. The most recent quarter and March of 2024, the trailing 5 years, just under 8%. The policy benchmark is 745. You're ranking in the right at the median, the 49th percentile. We go back again every quarter for 21 quarters to March of 2019, which would actually take us back to the period 2014 through 2019. On average, every quarter as we sit here, the 5-year trailing return over the last 21 quarters has been 7.75% relative to the policy benchmark at 7.25%. And on average, the trailing 5-year peer group ranking is in the top 35% or top third, effectively. And then finally, the 10-year, similar story. You can see the 10-year return, while it has gone down, beginning really from 2022 is when we started to see the equity markets really decline. 2020 was a good year. 2021 was a really strong year. That trailing 10-year number, when we were looking at the end of 2020 and the end of 2021, you can see was double-digit return. So looking very good. You will also recall at that time when we came in and did asset allocation looking forward, our expected returns for the next 10 years at the end of 21, at the end of 20, 21, and 22 was much more subdued, like in the 5.5% to 6% range. And that's because equity valuations were really expensive. Fixed income yields were near zero. So the go forward didn't look like the backward. We've seen a pretty significant unwinding in 2022 of equity markets, particularly in the US, and fixed income markets as yields rose dramatically. And that's what you started to see, that absolute return on a 10-year basis coming down through 2023, at the end of December of 2023, down to 6.7% trailing 10-year. At the end of March, this quarter, we've bumped up a little bit. On average, trailing 10-year return has been about 8.45% through a good period. Really, most of this period has been a strong period. We've got a couple of down years. On average, the 10-year peer group ranking of this portfolio has been near top quartile as we look at it every quarter going back 21 quarters. So I wanted to show this and explain what's in the peer group, because I think it does just give a little perspective. We know from quarter to quarter, month to month, quarter to quarter, things are going to fluctuate pretty widely relative to benchmarks and peers, but it's understanding why that we think is important, and remaining convicted with the overall asset allocation that we have over the long term to provide a reasonable probability of achieving their required return over time. From a manager perspective, don't have any specific manager issues or concerns right now. I know we're bringing managers in regularly this year. I think next on the docket is William Blair Small Cap. That is one where we do want to have a bit of a conversation. It's been somewhat of a challenge, as we know. We got rid of Mondrian in the international small cap when we added Silchester. Silchester's it's a value manager, but it's all cap, so they're moving further down in the small cap space. What we had talked about last year is potentially revisiting the international small cap allocation and maybe having a more core implementation than what we do now, where it's a bit.
Jason, if we were to give ourselves a break, which rolling period do you think is the most instructive?
A 10-year. This is
Isn't it too far,
well,
too long, man?
I don't think so. I mean, this is a long-term infinite time horizon portfolio. I do think work with a lot of public pension funds that meet monthly. And I think it's lost that the time horizon is very long. And talking about, month to month, quarter to quarter, even year to year. The 10-year in our belief is most instructive. I mean, we're looking at the 3 and 5 year too and trying to understand why. I think if you look at the 5 and 10, they're pretty similar. But I think looking over long periods of time, and even in the quarter report, if you go to page 25, we have even longer time periods, 15, 20, 25, 30-year periods. We don't have peer group data going back that far, but in looking at a 30-year time horizon, the portfolio has generated a 7.9% return relative to both the broad policy index and the strategic policy index, outperforming both. And really, I'd say relative to your primary objective, which is meeting your return assumption, which has moved over time appropriately because expectations change. Generally, we look over that 30-year time period, generated over what the required return has been for most of that. I said most of that because I'm guessing somewhere back there, you probably don't know, it's probably over 8.
Yes, I was gonna ask you, what was that discount rate 10 years ago? I wasn't here today. but
Yeah, it would have been
Anybody?
8. That's 20 years ago for sure.
So I'm wondering, the duration of our liabilities, my recollection was just over 10 years, something in the 11, 12 range. And we've got, to your point, the 10-year returns. I'm wondering what was our discount 10 years ago? So in 2014, I don't know if you remember.
I was here, but I don't recall what it was.
And did we, we're, based on the fact that we're 8, I'm assuming we're pretty close, but
I would assume so as well.
I think the allocation to fixed income, I saw it somewhere here is about 20%.
Mhm.
Do you know offhand what the duration on that portfolio is, or combined duration on the managers is at this point?
On the fixed income portfolio,
As an aggregate number versus independent manager.
I think at Western, I think they were pretty close to benchmark weight, maybe a little bit below, so about
7, 8.
I
yeah,
think
it's right around. Western is 7, so they're a little overweight the duration of the ag, and IRM is 6.15.
Which page are you on, Jason?
Page 68. And then so that's IRM. This is IRM characteristics. Their duration is 6.15.
So not tight. Are you all expecting the rate environment to change?
Over what period of time? Yeah.
Who knows, next couple of years? 2, 3
Yeah,
years.
we're not really predicting rates over the next couple of years. What we would say for our fixed income expectations, capital market expectations have increased dramatically for long-term investors because we went from near 0 rates to 5% rates on 10-year treasury. The yield on the ag is 4.85. That's the average. That's the yield to maturity on this portfolio. The yield on the ag is
What
actually,
you're saying is
higher
you are rate agnostic at this point, and usually are.
they usually are, because we're looking at long-term time horizons. For a pension fund, our expectations today going forward the next 10 years are better than they were 2 years ago. Because
Yet rate cycles are long, they're not short rate cycles usually. So, I mean, when you say long, I agree, but usually for PE compression, real estate, all that stuff, and private equity PE compression, usually those rate cycles are long. So just wondering.
Yeah.
When you are agnostic, do we have any kind of, but we can talk about that later.
Well, the key thing is whether or not our managers have the flexibility to lengthen or shorten their duration as they see the interest rate environment.
They typically
rather
don't.
than us trying to second guess what they should do.
But
Do
if-
do they have the flexibility to move to move?
But if you're using as your capital markets assumption, basically more or less the current yield, to your point on agnostic, you are being agnostic directionally. So in 2021, when we had to go forward for fixed income at, 1% or something like that, that was pretty consistent with where yields were. So you would say that there was no anticipation of a rise in rates over that, 10-year forecast period, right? I mean, and to be at 5 now would also have the opinion that over the next, 10 years, that there's not likely to be an increase or decrease in rates. It's just, kind of the coupon for the 10-year hold
Yeah, the
period.
capital market assumption isn't assuming major moves and
Right.
right now. I mean, we updated. annually
Well, it wasn't
where
3
it
years
is.
ago, or it wasn't.
But from
in
an
2021.
implementation standpoint, I think this is what Sharik is asking. Right now, your two managers that you have,
Yeah.
they're pretty benchmark constrained, plus or minus 20% duration. They're not, these are core managers.
They will not change.
Iron M's core,
Correct.
what WAMCO is core plus. They're not trying to use duration significantly. Western uses a little bit to generate return.
It would be similar to a large cap manager going into small cap because they see opportunities. It doesn't happen. They will follow their policy. So typically, they
Would be-
tweak it a little bit.
Which means that they will respond as the market, the fixed income market responds. If the fixed income market, if the rates in the fixed income market generally would go up, our duration would lengthen or whatever, they would respond in kind.
They could, a little bit around the duration of
Or if
the
they're going
index.
to be
These two,
neutral to the benchmark.
these two
by
managers.
definition, they would respond to changes in the benchmark.
right. As opposed to a unconstrained
Yeah.
manager, like there's a number of strategies that are really benchmark unconstrained. They don't look anything like the ag, and they're gonna do whatever they want, and they can move the duration around quite a bit. And the last several years, some of those, BlackRock, JP Morgan Strategic Income Opportunity Fund, those are two that are pretty widely used. They've had duration that looks like cash, like, basically a half a year or maybe even negative at certain points in time. And
Well,
so,
my questions and comments really get to, are the managers so constrained that they cannot react to the market? The answer is no, because they try to follow the market.
right, but they're not gonna go short duration. They're not gonna go
They're not going to try to beat the market on duration or
No.
whatever.
Well, but what Jason's saying is that, if I understood that correctly, they can only tweak it 15-20%. They will not.
around the
Yeah,
benchmark.
so even if they,
Around the benchmark.
Right,
so even if they think the rates are going up, they will not be able to go to short duration, only to
They're-
a certain extent.
no, not these two managers.
So maybe they'll shorten the duration from 7 to 6.
Well, WAMCO's actually extended the duration a little bit, and they've been long duration for a while,
Yeah.
since the end of 2022, and it's helped and it's hurt over a certain period of time. And they've extended because they think we're potentially moving, having more challenges in the market environment where if equities sell off, fixed income rallies, rates would go down.
Okay, good.
But that's really all I had, unless you want me to go into detail on other managers. I wanted to cover total fund and benchmarks significantly this meeting. Any other
Any
questions?
other comments or questions? So,
From a governance perspective, is that real estate, that 15% weighting, is that a board decision or is that ACG's?
that was a board decision. With the input of ACG and for that matter, of Summit Fire. Because I think it's been 15% for quite some time.
That was,
If that were to be revisited, I'm not pushing for that, but I just want to understand, but the mechanics of that, we're pretty locked up in some of the real estate. So there's not a lot of allocation adjustments that could be made. Is that
not in the short term. I mean, we could change the target allocation
Yeah.
and say we want to lower that target allocation, and then you put in redemptions and
what
there's
I'm saying?
exit queues to get out. So it can be done. If you want to strategically move your target to real estate down, we can change that target the implementation of that will take some time. And when we looked at asset allocation every year, we look at that target to real estate, and we can revisit that and do.
I'd always thought of real estate as our substitute for fixed income exposure.
Yeah.
And relative to a 60-40 portfolio, that would be true. But relative to the peer group, what we're finding out is that we had less exposure to equities. And not as much. I mean, we had a little bit more. The swap from fixed income into real estate was not a driver of return. So the fact that real estate underperformed equities was more a driver
Just in the last
relative
year,
relative
if
to
you
the
look
peer
at the
group.
last decade, having real estate in lieu of fixed income was a huge positive.
But it wasn't that much in lieu of fixed income. It was in lieu of equities. And so what I liked about real estate relative to fixed income is that you weren't getting much yield on fixed income. So you're getting a higher yield off real estate and you had the ability to capture inflation. Equities have the ability to capture inflation even better than real estate, right? So that's probably why real estate was a buffer in 2022. It's
Right.
because we're in more illiquid real estate that we didn't get the repricing like we got in 2022 in equities and fixed income. But that's what's rolling through now
Correct.
as
And
people,
you'll see that with private
Right.
equity too. As the
Right.
private equity portfolio builds, you're gonna have much greater deviations from your policy benchmarks in the short term. Over the long term, we would expect it to provide a premium for that
Right.
illiquidity. In the short term right now, we're seeing some of our clients that have large public funds that have very mature allocations to private equity, 10, 15+%. Private equity, and they may benchmark it in the policy index to the ACWI or to the S&P 500. Over time, we want to outperform public markets by 1 or 2%. Over the last year, if that's how your policy index is constructed, private equity is flat and the S&P is up 28%. So if you have 15% in private equity relative at zero, relative to a 28%, that's a big deviation. Longer term, 10 years, even 5, 10 years, even 3 years, it's been what we've seen, a pretty significant driver of return, but you're going to have deviations in the short term.
The key question, I think, is going back to real estate. Even though it will take some time to make changes in real estate or real estate allocation, should we consider reducing our real estate allocation? Given the economics, certainly in the office market, I think the industrial and residential markets are doing very well, but the office market is tough.
Actually, BlackRock just said that they are bleeding on their, and their multifamily and their home portfolios, so
Hmm.
it's
Well-
not just on the commercial.
But the key thing is should we, given what we think are intermediate term fundamental issues facing the real estate market, whether you consider those high or low issues, or low intensity, low risk issues, should we change our target real estate allocation? Recognizing it will take some period of time, but also recognizing we just use real estate as a source of funding pension obligations rather than anything else. It's not a matter of taking down real estate and putting equities, we're taking down real estate just to fund our pension obligations. So that's an issue, that's a question. I don't have an answer. I have a predisposition, but I don't have an answer.
No, if I may too.
Please.
I think part of that consideration is not even just what's the forecast for the real estate market, but it is recognizing that's a pretty big bet relative to our policy benchmark. And are we as a board comfortable with that, I guess, somewhat of a outlier allocation decision?
Well, it's in your
It's
policy.
a big
No, I
bet.
understand that. I'm just saying.
Yeah.
It,
It is a big bet, but compounding that. When bad times occur, all those vehicles that were open-ended,
yeah, right.
when we went in, we
Exactly.
find out that they're not open-ended anymore. So it becomes an illiquid bet.
I totally-
And if we had gone into real estate at a 15% allocation, if we had anticipated it would be illiquid for an extended period of time, I don't think we would have. but
The other thing you can consider on real estate that we've talked about in the past so that you have a better ability to adjust relative to target is have some component of your real estate allocation liquid,
Yeah,
right?
yeah.
And I know we've talked, there is a small subset of our equity allocation that has real estate, has REITs in there. But I mean, if 20% of your real estate allocation was REITs, you could draw from that. You could use it to fund your direct real estate in growing times. You can use it to reduce your exposure, where we can't when the gates go up. Now, it gets repriced quicker, so you're going to see more volatility in the return. But this was the conversation we had with the real estate team, a few years ago, is the underlying asset that whether it's a public real estate owner or a private real estate owner has the same volatility. It's just, it got repriced in 2022. The REIT has got repriced in 2022, maybe more, maybe, less, but this is now rolling through. And so again, just
So the real estate helped you in 2022
correct.
considerably from a protection in that period.
But it really didn't. It just helped us from
It
a,
did
from a,
when you measure-
reporting.
When you measure your assets and liabilities at year end, it helped. Right. So that helps from a contribution status and a funded
Well,
status.
but that was my point, is all we're really doing by having private real estate is reducing the volatility of the return. So on a Sharpe ratio basis, the return may look better, but the underlying asset was repriced in 2022. It just hasn't rolled through here. So we said, oh, great, let's get out, let's reduce our exposure because we all know the value of the underlying is less, but everybody was doing it at the same time. So now it just took a while for that to roll through. So you've got this drag going forward. It's the same thing when bonds get repriced, right? I bought a bond at a 1% yield and now the market says I want 5 for that. Well, I can hold the bond and like the banks did and say, I don't have to reprice this because it's held to maturity, but it's going to be a drag on my earnings until that bond, matures for cash.
We can revisit the asset allocation and looking at what lowering the target to real estate and reallocating that somewhere else. If you choose to go that direction, the ability to do that immediately it's going to take some time to get there.
I mean, the key is what the rates do, and I understand nobody knows what they're going to do, and we cannot find that answer somewhere. Yet, I don't know if we can afford to be sitting on this board totally agnostic as we make these decisions, so as to say. I don't know if some kind of conversation, what you think is appropriate, and so.
I just want to maybe go back and try to reinforce the point here a little bit, which is I really think the heartburn for me when I think about this is not about the forecast for real estate, it's the dispersion of returns relative to the benchmark. The outside the band of our portfolio. So I'm asking for Jason, as we're thinking about that, is you help us understand that what is the delta, or what's the tracking error being created by that?
When you say dispersion relative to the benchmark, what benchmark are you talking about?
Peer group, either one.
Because the strategy.
Well, I understand that.
We're not getting dispersion relative to benchmark because the
Right.
benchmark's track.
Okay.
Right, so when you compare to peer
Policy
group,
index,
when you compare to peer group, right.
I mean, you're using a policy index for that, right?
Right, the strategic
So
policy
it's
index
the policy
includes
index.
the Odyssey.
I would say, I guess I'm referring to the market benchmark then, or a peer benchmark.
Yeah, the broad policy index doesn't include real estate.
Right. I know.
So that's, you've got dispersion. So
That's exactly-
strategic policy index is more reflect, that's your,
Okay, then I would say I'm asking relative to the broad policy benchmark then. So.
That's the 7% dispersion that he.
That's
right.
what-
So if we're worried about that, then I'd say,
Then you just,
we've got to get rid of real estate and that.
and you're just in equity and.
Right.
the
I'm not
aggregate.
saying we should do that. I'm just trying to understand that because we've made that decision, what is that range of outcomes relative to the broad market benchmark? And are we comfortable with that level of dispersion?
Yeah,
That's all.
Dispersion
relative to the broad benchmark. It's a.
I guess the other question
Reinforce the fact that
is,
it's illegal.
which is the more relevant benchmark?
You can't just
Okay, honestly, I want to pass on this subject. If I'm not making my point clear, so.
I think you're.
I think we have to define what's the relevant benchmark.
I guess, this will be my last point, honestly, is that I think when we're looking at the performance, that real estate decision is costing us pretty significantly. How much tolerance do we have for that persistent underperformance? Oh, and I recognize that it's over a relatively short amount of time. So that's all I'm trying to get at. I'm not questioning the decision. I'm not saying that it's wrong. But from a purely relative basis, how much longer should we accept that underperformance? And at what point do we do something differently?
I guess I'm still stuck on it's relative to a broad policy index, which doesn't include real estate. And
I'm not saying that it doesn't. I'm not.
and I'm not sure that that's the most relevant index, I guess is what I'm saying.
I'm not,
Relative to peers, if we're concerned about peer group ranking, in the short term, it's hurt. In the long term, it hasn't. In the long term, it's been beneficial relative to peer groups. So,
can I add something? When we originally adopted the 15%, it was years ago. We didn't adopt it with an illiquid frame
I
size.
understand that too.
We would not have had 15% illiquid real estate investment coupled with the more recent, 12% illiquid private equity. So 27% illiquid, that would not be something we would have adopted. So I think your point is well taken, but I look at it more fundamentally rather than vis-a-vis a benchmark per se. It's higher than what we would want considering it's illiquid. In bad times, it's illiquid. It's only become illiquid, but maybe that's what we should have anticipated years ago, that at some point it's going to be illiquid. And when it goes illiquid, it's illiquid for quite some period of time. Same as it was in 2008, 2009. And my clients were burned with that. I was burned with that. It took 2.5, 3 years to work all that out. And so one could look at it today and say, it will eventually be liquid, more liquid than it is right now. But do we want to have a 15% allocation in something that has these periodic periods of illiquidity where you cannot adjust the portfolio and cushion yourself?
I think we
And
weren't
then
around
that's a
when
question we didn't
the
have.
original decision to go to 15%, but we recognize that for private real estate, it's can be illiquid. I mean, it's not we recognize from an implementation standpoint that core real estate is an illiquid asset class, or can be.
Can be.
Can
An
be.
illiquid asset class when you want to, and it's probably going to be when you want to get out because it's doing bad. That's when it's going to be.
Yeah. Of course, if we're all REITs, which I wouldn't necessarily recommend either, and you should adjust that.
And the same with private equity. We know
Of the office market or whatever, whichever sector in real estate going forward. And so it was 15% too much. I think it is too much. Recognizing, even if we were to say it's too much, let's reduce it. It's going to take time to reduce it. But I'm thinking of, we already made a decision. Let's not double down on the decision for.
well, we can look at from an asset allocation standpoint, run our asset allocation models to show what the risk and return does by reducing the target to real estate, whether you get there or not.
Yeah.
Say, are we comfortable with adding 5% to fixed income and 10% or reducing real estate by 5% or whatever?
And with all the uncertainties that exist even in the equity market, I think the real estate market is almost impossible to anticipate where the opportunities will be over the next 5 years, particularly in commercial. And this is something fundamentally different going on. We're not talking about normality.
The other discussion, some
This is something
investors have.
fundamentally different. Because it went illiquid back in 2008, 2009. But not because there was a fundamental change in the demand for office space, which came out of COVID. and persists even to this day. And eventually, maybe all of that office space is taken up. But I don't know when that eventually is going to happen.
Do we have, sorry, do we have a breakup on the real estate in terms of sectors? I mean, that would be helpful.
I went to,
They-
2 years ago, I met with the real estate analysts at ACG. The leverage in the real estate portfolio is quite low, to almost non-existent. I mean, it's a fraction of what public REITs use. And the exposure to office was also
If you go to page
maybe
78.
10%, if I'm,
Sorry, what page?
78. Well, it's not rolled up, but we can do that for you. You have 3 different managers. You're in Reef America 2, Heitman, and Prudential, versus 3%. So on page 78 in the lower right, you see the allocations for a Reef. It's about 70% apartment and industrial, or multifamily and industrial. Office is 15.6.
That's high.
This is Reef. Retail is 12 or something, so it's heavily allocated to apartment and industrial. And 82 is Heitman. They're a little bit different. They've got a lot of self-storage, which is not part of the benchmark, but that's actually done well, and that's going to become part of the benchmark, the other piece. Their retail and office is 27%, and apartment and industrial is almost 50%. And Chris,
again, I would, apartment and self-storage are low duration assets, right? Because you can pass along rental increases either, generally annually.
Right.
Industrial tends to be 10-year. I mean, those are your longer term leases. So those are long duration assets, and typically office too. Suburban office maybe a little bit short.
I'm posing a question, you don't have to have an answer today, but I think that's.
and then
dig into it a little bit more.
to touch on Prissa, I mean, they're almost 60% multifamily versus 3.
Nevertheless,
They are. There is an execute.
because it's not there. And maybe they're liquid because everybody wants to get out.
Mhm.
You put in
There is no orderly way to take money out because everybody wants to get out at the same time. And therefore, I would put the question back on the table, is this something we want to revisit with the thought of possibly reducing it through just
go further.
as best we can over the next year or two? Reducing that allocation, not putting money back into it. Maybe it's so. Maybe we're not putting money back into it anyway, but perhaps we ought to consider changing the asset allocation part.
In terms of these, Heidman and Reed payout, and we receive those, Prissa is reinvested.
They were reinvested.
Prissa is,
Dividend.
Prissa
Prissa were reinvested.
is so any payout that Prissa makes is reinvested. But Heidman and Reed, we receive the payouts
The dividend,
and dividends, yes. So, but any kind of,
but we have
We get
redemptions
redemption requests
as well. We have a 20 million.
oh, yes,
redemption
in turn, Reed,
From Reef.
and we're about 50% through that.
Again, my question is, can we go from 15 down to?
We can do asset allocation, or we can look at that, yeah.
And recognize would this be a trade-off between long-term return on equities, for example, versus long-term return on real estate? Recognizing that with stock, you can always sell it, you can buy more of it, you can even go cheap. In real estate, it's a little bit.
Also, what would be very helpful while we're on the topic is how much can you liquidate with how much, what kind of penalties, not in terms of withdrawal penalties, but in terms of what's aggressive and what can be done. So you'll have to have a conversation and give us a feeling
Yeah,
of
there's
what
no-
can be done.
There's just an exit queue. So when you get in the queue, you're in line to get out when your turn comes up. or depending on the fund, they may be releasing a little bit each quarter, depending on what they can sell.
But in terms of the Q being 5 billion and our withdrawal being 25 million is insignificant versus our withdrawal being 50 million versus the Q being 250 million is very significant. So that would be helpful.
We can provide that,
Okay.
an update on that.
For next,
Mhm,
yes, for our June meeting,
mhm.
please. Does that get to your point, Jess? Does it? Yeah. All right.
Well, and that's what I wanted, why I wanted to point out the dividend reinvestment of, because one immediate action we could take is
Absolutely.
to
I agree.
change that.
I agree.
And that is not reinvesting. So that's just one immediate action you could take.
I don't see any reason why we, sorry.
I don't know. Okay.
Okay.
It seems to me the driver of capital markets assumptions, when you get down to it, is inflation, right? I mean, and so if you don't have a call on inflation,
Exactly.
what do you, I mean, the question, tracking error to me is the risk that the investment manager or the consultant or the board gets fired, right? If you underperform for a long period of time, they're gonna find somebody else to do it, right?
Wait, can we get fired?
Our job is to avoid permanent losses of capital
We are.
and to be able to capture as much of that inflation as possible so that, okay, and so if you don't have, I mean, and that it was a couple of years ago when we were talking about the capital markets assumption. You know, I said I'd take the over on inflation. Now, again, I'm one member of the board. I'm not trying to drive it, but if you think there's a structural change, that we had 40 years of declining rates because inflation coming down, and you think that reached its low point, well, it would be, you know, it's at some point, now, some point can last a long time. If you think you're these long cycles, I mean, we had rising rates from 46 to 82. If there's been a secular shift, it would seem to me you would want a bias towards low duration on fixed income, and you'd want a bias towards inflation capture in real estate. Okay, so that's my underlying worldview, and that's not to say that you're not going to have periods where inflation comes down, but you're going to have more inflation volatility. But I think you're going to end up seeing higher highs, higher lows each cycle, and so I would be more worried about how we protect that. And I don't think reducing real estate, again, depending on, is necessarily the best way of achieving that objective.
If we had 20, well, in terms of capturing or protecting against inflation, equities would do that as well.
They should, yeah.
Certainly more than fixed income.
Yeah, fixed income typically won't do it. But equities can do that as well.
Mhm.
And so I'm still of the mind that having the illiquidity premium here is working against us.
At the end of April, over the last 5
$20
years,
million of free cash sitting over there in suitcases. Where would we put it today? Put it in real estate
not in core real estate,
or any real estate?
might look at some distressed real estate funds, but they're more illiquid, closed-end type strategies. If you had,
You say close down.
well, right,
Yeah, that's also a definition.
but you said that from an opportunistic standpoint, there are some distressed real estate strategies
I
that are
understand.
structured as closed-end funds that
Yeah.
should be addressed. But
And
just want to point out your
would we-
your real estate
This
allocation.
particular fund, would we do that? I don't think we could do
No.
that. That's what I'm talking about, this particular fund. I'm not talking about me personally, or you or Brian, because we may be very patient and wait for the upside. This particular fund has different demands and needs. And transparency issues.
Just so everybody's aware, your real estate is up 4.5% annualized the last 5 years through April. Fixed income is negative over the last 5 years.
Yeah.
Through April.
That's fine.
Well, it's fine.
The real estate is.
Right. Now, again, I was thinking we were using real estate, and it relative to a 60-40 portfolio, we were using real estate as a replacement for fixed income. Relative to the peer group, we were using real estate more as a replacement for equities. And that's why, I mean, even at 4%, that's less than what equities have returned. And so that's why we would be underperforming a peer group during
I'd say
that period of time.
also, when you have a 7.5+% return objective in a rate environment where rates were at 0.
Mhm.
You're using real estate to provide a premium return to fixed income
Yeah.
with less risk than equities, rather than
Yes.
just adding.
I would agree,
Take-
but again, relative to the peer group, that peer, right, the peer group was using about half the real estate we were using. So we had an over allocation to real estate, an under allocation to equities, and a slightly under allocation to fixed income, just relative to the peer group, not, I mean, again, just.
And we don't know.
And so there's your explanation why for this short period of time, we would have underperformed that specific peer group. But that doesn't mean that the long-term allocation
And over
was,
5 and 10 years, you've outperformed the peer group. So.
right.
Okay. Let's go into the next one.
So we'll have a full value. We'll revisit the asset allocation and specifically real estate implementation, looking at the Qs of the underlying funds. Where they are.
Is there more?
No.
Anything else from the board?
I do have, I'm sorry.
Yeah,
Mr.
please,
Mayor,
please.
this is the,
That's
just
why we're
remind-
here.
we met with private advisors, meeting, where are we with
Portfolio
the
advisors.
committee portfolio advisors? What is the thinking on that commitment for the fund they're raising right now?
I think we'll probably come back with a recommendation later in the year for that next fund.
Okay.
And what is your question?
Well, just, I'm connecting that a little bit to the real estate question, and you appropriately point out that 15% of the portfolio is locked up on the real estate side. We've got still, correct me if I'm wrong, Lisa, the original commitment to portfolio advisors, 60 million, there are 30 million drawn, so we still have $30 million of undrawn capital on that previous commitment. And my recollection from the last meeting is we were contemplating a $60 million commitment to the next fund. And that would effectively give us round numbers, $90 million of uncalled capital. Thinking of those two commitments in aggregate. And from a liquidity profile, we can full with that.
Again, the asset allocation of it's a 6% target has been in place for years, and we're.
That 6% target probably was not put in place with the assumption that 15% of the portfolio was locked up.
No, it was.
It locked up, though, illiquid.
Well,
So that now you got 20% of your portfolio.
Yeah, I mean, we
is illiquid, but when the duration of our liabilities is
Yeah.
12 years, that doesn't seem to be.
you know, there's no liquidity issues. And if we want to revisit the allocation of private equity too,
The challenge I would get at is if you're going to have private, whether it's real estate, whether it's credit, whatever it is, it's going to lag because the public markets are going to reprice immediately. And it's going to take a while for that to work through the valuations. But if we're always going to want to reduce what's not working, you're going to be
I'm not.
right. And
suggesting that because-
so that's that, then you should just stay public and everything's measured the same and.
Yeah, my concern, none of that.
Yeah.
I totally agree.
Yeah.
and so our pacing plan that we showed doesn't even get us to that 6%. I don't think within the next 5 years. Even at, I don't remember telling you if the number was another 60 or if it was like 40
Okay.
this year. And then 40 in 2 years from now.
You're talking about private equity,
Talking about private equity.
4.5 to 5, isn't it? Before you fully invest. And obviously that depends on what the overall portfolio.
But our pacing plan that we showed was fairly conservative, not getting us to, now it could be wrong. There's a lot of estimates in that, but we're coming up with conservative commitment amounts so as not to get too overextended. And the way you get overextended is if you have a significant sell-off in public markets again, and then you're continuing to put money to work in private equity.
I was totally just thinking about it through the lens of liquidity of unfunded capital commitments, benefit payments. And how does that look? And if there is.
And that's part of our asset allocation analysis that we look at, like the amount that's illiquid, and at most, we have 20% in illiquid or less liquid strategies, which is but you've got more than sufficient liquidity in this portfolio to meet your operating needs. And honestly, relative to other large public funds, that's, well, so are the numbers. That's right.
I don't think we have a clear problem.
No.
At this point, you can demonstrate that. You've been through that analysis previously, just show the analysis. But again, I don't think we say 15% here or 12% there, 27% there. And maybe that's how people should always look at real estate. It's a liquid.
Yeah,
And can you handle it if it turns a liquid? That's how we should look at it.
and
But this.
cues are in place so as not to harm long-term investors
Right.
in the fund.
Right.
So that the fund is not required to sell properties when it's not.
Exactly, when it's not.
So that's, so we should know that going in. Well,
Okay, Tony? Yes. Anything further? Brother? Sheree? Billy? Okay, what's next on the agenda here?
Correspondence and then visitors comment.
I'm sorry,
The correspondence and then visitors comment.
Jason, is there nothing else you wanna chat about at this particular?
No.
All right, correspondence, anything of particular note? There was something from Granite, as I recall. New business? Anything lingering from the last meeting that we need to talk about, old business? All right, we can have, I think we ought to have an opportunity for visitors to make a comment, or their comments or questions, and then we're gonna go into executive session. Joyce, Barry? Okay. By the way, I don't know if everybody's aware of what you told me prior to the meeting, Marion.
Dave Wilkins, who is the county retiree and often appears here to share his views, was hospitalized and had open heart surgery, bypass surgery last night. He's alive, we don't know.
I did hear from his wife that he did make it to surgery. And they didn't get done until like 1 a.m. in the morning. So
Gotcha.
It's a brutal surgery.
So if you guys could keep me posted, I'll make sure the board keep them posted.
I'm bringing that up just because Dave Gokin. Becca was just asking you to keep her posted so she can keep us posted. And we're just bringing this up. Davis is one of thousands of retirees, but he uniquely is one of the few who actually comes to meetings and has been since late 2019, consistently at meetings, matter of fact, missing very few during that period of time. And I just thought it ought to come to everybody's attention. All righty, in which case we can have a motion to go into closed session. Maggie, help me out on the process. Do we?
Well, you would make a motion,
to close?
motion would be approved, and then you would take a roll call vote.
Okay. Do we have to have a motion to close this part?
Yes,
The opens?
yes, there'd be a motion to go into closed session.
So, okay, and Sharif just seconded that motion.
And then you would have a roll call vote, which Matt can take it.
Okay, first of all, is it acclamation that we're going to move out of open session? And now we have to have a motion to move into closed
No,
session.
you gotta do
Roll call.
the roll.
Right, you gotta do the roll call.
Call the exit.
Thanks, Jason. This is a process.
And I say yes. Right.
This is not substantive. This is housekeeping.
All right, I'm first on the list.
All right.
I'll do it right this time.
Right, Anson.
Yes.
All right, fine.
Paul
So
Hamel.
do we have a roll call first? Or are we going?
We're way ahead of you.
Taking it now.
Yes. Hold on. Becky?
Everybody, if you could just wait a moment, IT is going to put us in a breakout session, so those that are joining us online that are not board members are not going to be involved, so
We can disconnect.
it's recorded, so.
You're not recording a closed session.
No, I know, but we can't just disconnect.
Don't we need a motion and a roll call vote to go into
We
it?
need to,
Excuse me,
we haven't done.
the visitor session is over.
Yes.
So the people who are attending have no other opportunity to bring up anything, and they're not going to bring up anything anyway. And therefore, we're going to move on if we were going to ask the visitors to sign off, but if they don't sign off, we pull the plug.
Well, let me back up. In the past, what you've done is you've voted to go into closed session, then you voted to go out of closed session. You never closed the open meeting.
That's my question. That was my
So,
question.
so if you want to go ahead and close the open meeting now, well, see, I think you need to vote in an open meeting to go into closed session. So I think we need to follow the protocol that we've done before.
That's what it is.
So what they're doing is they're basically putting, rather than disconnect and try to reconnect anybody who might be out there.
We're putting them in the green room.
Right, because technically, you know, Becky, at the end of, when we vote to go out of closed session, okay, we're back into the open meeting. Those people that went out there, they can all come back in.
In theory, they can come back in.
Correct. So you would try to maintain that same availability for the online people to the
Keep the
extent there.
opportunity open.
For them to come back in.
Correct.
Even though they're, for that,
Once you close it.
Correct.
they didn't have anything to say previously, they wouldn't have to say, because we're not gonna have anything else to talk about.
They can still watch.
Fine. They can watch us adjourn. Right. Okay, fine. So therefore, can you have a roll call?
Yep, I'll start over. Brian Hanson,
Yes.
Paul Hample,
Yes.
Sharif Mansuri,
Here.
Jody Patterson,
Yes.
Anthony Waskowitz.
Yes.
Milton Wilkins.
Here. All right.
Yes.
We're gonna go into closed session. Now,
I would request.
Pardon?
Recess.
2 minutes.
I'm sorry, Vicky,
Did we
what?
have to vote, or was that just a roll call? So you
We
guys
took
don't-
we took a
that was
vote to
the
go
vote.
into closed session.
Yeah.
Okay,
Wanna Make sure we've done it
all
right.
right. So now we are in closed session. So there should be no one who is able to, you should not be recording this, and no one who's outside should be in this meeting.
June 25th.
Yes, sir.
I move that.
Same time, same station.
That's second.
Thank you, Paul.
All in favor? You voted to adjourn?
I,
Thank you.
Thank you.
All right.
what time?
Thanks to all of you for your patience today.
See you next time.
All of you.